All right, guys, it is FOMC week, and we think we have a very interesting setup for some short-term tradable opportunities across major asset classes this week based on the fact that so much hawkishness has already been priced in for this meeting. We're not sure whether the Fed will be able to surprise on the hawkish side, and that could provide some classic sell the fact reactions across major asset classes. Now, as always, when we approach any type of incoming risk event, it's very useful to have a process that allows us to zero in on what outcomes would create the most attractive tradable opportunities. And for us, that's a very simple process of firstly establishing what is the baseline for any meeting or what is the baseline for any event, i.e., what's already been priced, what's already expected. And then based on that, building out a few scenarios where we think the markets will be surprised. What will surprise the markets on the dovish side? What will surprise them on the hawkish side? And then based on those outcomes, whether dovish or hawkish, whether we think that changes the bigger picture, if at all. If it doesn't change the bigger picture, it's probably worth a short-term trade. If it does potentially change the bigger picture, then obviously a more medium-term trade could be appropriate. So let's start with the first one, which is establishing the baseline of the event. Basically, what is markets pricing in and expecting from the meeting this week? Now, if we take a look at rates pricing on the STIR side, a 50 basis point hike is already 100% priced by STIR markets. I mean, STIR markets are implying 52 basis points for this meeting. Now, it's also important in this specific case to not just look at the meeting this week, but to also look at the subsequent meetings, looking at June, looking at July, where we can see that right now the markets are also pricing in 50 basis point hikes for all three meetings, not just May, but May, June, July. So three back-to-back 50 basis point hikes already priced by the markets. That's a pretty high bar to surprise on the hawkish side this week. Now, if we take a look at quantitative tightening, same story. Markets are and have already priced in an earlier start to QT, thanks to the comments from Fed's Brainard a few weeks ago. She did later clarify that QT might be announced in May, but only start at the beginning of June. But either way, markets are pricing in an earlier start to QT compared to what was previously expected, which was a July start. Now, the pace has also already been leaked to us by Fed members, 95 billion in that range, meaning 60 billion treasuries and 35 billion in mortgage-backed securities. So again, quite a lot priced and expected for this meeting already. Now, what about the language? What about the tone? It's obviously always possible for Fed Chair Powell to lay it on very thick and let his, inner hawk fly during the press conference. But again, realistically, what can he say that hasn't already been said and priced into the markets? When you have some of the most dovish members on the Fed board, letting their inner hawks loose, that can really desensitize markets a little bit. So, for example, taking a look at comments from Fed's Williams and Evans, they are, in my opinion, probably considered some of the most dovish members among the FOMC. And if you take a look at what they said, I mean, for them to come out saying that, yeah, we could probably do a couple of 50 basis point hikes, getting us to 2.5% by year end, that's very, very aggressive talk from these guys, looking for a neutral rate by the end of the year, looking for back-to-back 50s, and possibly going into next year needing to raise the Fed funds rate to above neutral, depending on inflation. So again, with these types of comments coming out from the doves, that can really desensitize markets on the hawkish side. So again, a high bar for Fed Chair Powell if he really wants to outdo that hawkishness that's already been priced based on the recent comments. Now, based on that, based on the baseline, what will really surprise markets this week? Now, even though I'm talking about a dovish surprise, dovish here doesn't necessarily mean we think it's going to be dovish. In this case, we think the Fed comes out hawkish, right? If they just deliver on what is expected, that is going to be really, really hawkish. But that hawkishness is already priced. So our question going into this meeting is, yes, we believe they're going to be hawkish, but can they be hawkish enough to, to surprise markets on the hawkish side? So if we think that, or we know from a STIR markets point of view, that three back-to-back 50 basis points is already priced, it's going to either take a 75 hike or signaling that it's going to be 75s, a couple of 75s to really surprise hawkish. On the dovish side, if they really wanted to surprise dovish, which we don't think they will, they can do a 25. We don't think they want to surprise or scare the markets doing a 25. We think they'll do a 50. But if it's just a 50 and there's no clear comments coming out from Fed Chair Powell that more 50s is on the cards, that can obviously be seen as less hawkish, if you will. from a baseline perspective for the rate path, 250 basis points is already priced by the end of the year, right? So if they want to really surprise, that means that they would need to see them going above neutral already by year end. Remember, they think they can hit neutral, which is assessed at being about 2.4%. If they say in the meeting that they think they're going to go above neutral, maybe 2.7 or 3% by year end, very hawkish stuff. On the dovish side, if they just say that they think they're going to hit neutral by year end, that's already priced. And if that's already priced and they don't outdo that hawkishness, that can be seen as a less hawkish, if you will, a comment from the Fed. Then in terms of the hawkish tone, again, a hawkish tone is expected from the Fed. So he really needs to talk up the economy massively, right? Talking up rates, talking up above neutral by the end of the year, talking up everything to really surprise on the hawkish side, where if he just delivers as expected, which is a hawkish tone, the markets has already been desensitized to a lot of what's been said. So again, that poses some downside risk. Again, in terms of the economy, they've said previously that the economy can handle hikes, and they think that they are comfortable to even hit neutral by the end of the year. So if they come out and they just throw a massive blind eye to market conditions, to obvious stressed conditions in financial conditions, in equity markets, in cross asset volatility, if they throw a massive blind eye to that, that can be seen as a hawkish move from the Fed. At the same time, though, if they start to sound a little bit more worried about the risks, remember, they've shown no risks until now, or at least sounded, they haven't sounded any type of alarms until now. They've said that they think the economy can handle it. So if they start to say things like, we're watching financial conditions carefully, we're watching cross-asset volatility, if they start to say things like that, that can be seen as more of a dovish sign, because they're starting to look a little bit more or sound a little bit more worried. And then in terms of QT, we already know that they're expecting to announce QT at 95 billion. So they need to do a higher pace than that to really surprise on the hawkish side, or a lower pace than that, or just at 95 to be seen as hawkish, but not hawkish enough to surprise once again. So taking a quick look at all of this, that means that we do think the market is vulnerable to a just classic buy the rumor, sell the fact reaction, where so much has already been priced. And we'll look at a few cross assets as well. We think so much has been priced, there is really a possibility of a sell the fact reaction going out of that meeting. So let's take a look at one of the most important ones, as always, is the US dollar. What do we think about the dollar going into this meeting? Now, it's safe to say, looking at the price action, that a lot of hawkishness has been priced for the dollar going into this event. We did trade at 20-year highs for a little while last week, trading at 2002 levels sometime last week. We've now slightly backed off those highs, but we're still right up there. We're still into key resistance. Price action has been very one-sided without any real notable pullbacks in the last couple of weeks. RSI is currently trading at levels which is usually, most of the time at least, signaled some local tops. So we do think things are looking fairly stretched right now. Now, that is from a price action point of view. If we take a look at it from a positioning point of view, the most recent CFTC positioning has given very little away in terms of signals, right? If you take a look at large specs, leverage funds, asset managers, very little changes there. The dollar isn't at extreme levels, but we are still very close to these recent tops, around about that one standard deviation level, where we have seen, which usually did signal local tops. So again, that feeds back into what we've seen from a price action point of view. Then something that's always important to keep in mind when it comes to the dollar, there has been more than one reason for the upside in the dollar, which is very important to keep in mind, because we're so focused on the Fed, looking at the Fed, what can happen for the Fed. Has it just been the Fed that's been, driving the dollar to the upside? No, we've had risk sentiment, which has been very negative. If we take a look at equity markets across the board, we've already seen a lot of downside pricing over the past couple of sessions. That has aided the dollar from a safe haven point of view. The other one, though, which is oftentimes overlooked, if we take a look at this chart, let me just show you guys here. We have the SETI surprise index, the global one. We can see that the dollar normally has that inverse correlation to global growth. So the fact that there's been building expectations of a growth slowdown on a global scale, obviously with China's challenges coming to the front again last week from a COVID perspective. That upside hasn't happened for no reason. But we do think that based on what's already been priced in from a growth perspective, what's already been priced in from a risk sentiment perspective, that some of those things, might be already reflected in the price, and again could lead to some sizable downside, at least in the short term, if we see the Fed coming in hawkish, but again not hawkish enough. So at these levels, we are at cycle highs. We are close to, let's just go back to the dollar here. We are at cycle highs. We are at 20-year highs. With everything that's priced in for the FOMC, we do think there's downside risk for the dollar if they just deliver on what's already been priced in. Now, in terms of our analysis process, looking at the baseline, looking at the surprise potential, looking at the bigger picture, if they come in hawkish but not hawkish enough, we do think that creates downside opportunities for the dollar. Do we think that changes the bigger picture? No, because we think that from a cyclical point of view, where we are right now in terms of growth, equity markets will only be able to really turn around once the Fed does a Fed put. And we think that's still a couple of months away, couple of downside data points away before the Fed starts to really pivot in that direction. So risk sentiment issues won't go away, growth issues won't go away. So even though we're looking for some short-term reaction lower in the dollar, it doesn't mean that that's going to be a bigger picture change. We're not looking for the dollar to go back to 89, for example. We're just looking for a little bit of tradable downside that we can look to take advantage of. So what about some other markets? Let's take a quick look at yields. I think yields is also very interesting here right now. Again, from a possible buy the rumor, sell the fact reaction. US 10-year now, we're currently trading very close to the prior cycle top, which came in at October 2018, right? Where we had a very similar macro environment with growth slowing on the one end, but the Fed staying very hawkish, basically staying hawkish on autopilot. However, there's two big differences. The big differences is this time around, CPI is more than 4 times above the Fed's target, which says something. And then obviously the level of the federal funds rate, here we can see the effective federal funds rate in yellow. We are miles away from where we were at the previous stop. Now, keep in mind, getting to 2.4% in as little as 6 months opens up a lot of growth risks. Now, until now, we know that yields have been mostly driven by the inflation side of the economy. But if they start to come out so aggressive that it starts to once again impede some additional negative expectations for growth, we do think that means downside for yields. Do we think that happens now? We probably need to see yields, inflation peak out before yields peak out. Even if the growth picture comes into focus, inflation is in control right now. If inflation starts to show some real signs of slowing down, we think the top for yields will be in. But until then, it's very difficult to call that top. What we're saying, though, is that we don't need to call the exact top going into this FOMC meeting. We think so much has been priced. Again, just a very simple sell the fact reaction can see some sizable downside based on what's already expected. And that opens up some opportunities for bonds in the short term, at least. Then what about the equity space? I mean, cyclically, the recent downside makes sense, right? Slowing growth and hawkish policy is an ideal mix for downside and risk assets. And that is unlikely to change anytime soon unless the Fed does a put, a Fed put like they did back in Jan 2019. But again, based on inflation, that's probably still further away. But from a short-term point of view, things are getting quite interesting here for equities for a possible bounce. If we take a look at some of the recent data, a very handy chart here from Pepperstone that shows the current AAII investor sentiment, we can see that we are now at the most bearish levels for equities since 2009. So close to a 3 standard deviation move away from the long-term average. That means a lot of bearishness is priced already and makes higher forward returns more likely from these types of stretched levels. So that is a positive for equities going into the FOMC. Again, if we assume a sell the fact reaction, equities look interesting. Also, if you take a look at this, on the growth side, markets have been expecting a slower growth environment. If you take a look at this recent chart from the BOFA Fund Manager Survey, it shows the most negative growth outlook ever. So ever, all-time lows for growth outlook. So again, even though we expect growth to slow further from here, markets are already prepared. They're well prepared for this in terms of expectations. So again, taking a look at things like the VIX, if we take a look at the VIX right now, we've seen a lot of upside for the VIX, and that is to be, expected based on the recent volatility we've seen in the equity space. It's definitely high, and uncertainty is growing. And based on the basic rule of 16, a level of above 30 implies just over 2% daily swing. So the markets are definitely edgy, but also the fact that the VIX is close to 36, which has been a local top for going back to when. Let's just see when. So the last time, this one was a little bit high, but going back to September 2020, every time we tried to pierce above that level, we've seen that mean reversion kicking in for the VIX. So getting close to that level tells us something. It also tells us that the market isn't complacent on the risks right now. Equities have sold off. The VIX have pushed to the upside. So downside protection has been bought. And as a mean reverting gauge, we need to really keep the risk of a push lower in the VIX in the back of our minds going into that FOMC meeting. So with the price action bearish, let's just quickly go back to that chart. So, with the price action bearish, investor sentiment bearish, fund managers very bearish on growth, downside protection being bought, and with a lot of already, hawkishness priced in for the Fed, again, the risks to equities, we think, is to the upside going out of the FOMC meeting, at least in the very short term. The other asset that we always look at when we trade something like the FOMC is, of course, gold. Now, there's two reasons why gold upside on a sell the factory action can be very interesting. Firstly, we always need to keep that inverse correlation between US 10-year yields and the dollar with gold in the back of our minds, right? If we take a look at this chart over here, we can clearly see that inverse correlation between gold and here we have nominal yields and real yields. Now, we haven't seen gold really reacting to the downside over the past couple of weeks based on the upside in reals and nominals. And we think that's been mainly based because the second reason why we like gold is because it's considered as a growth hedge, as a recession hedge. So if we do see a sell the factory action, which means yields downside, dollar downside, we think that can provide some attractive opportunities for gold, trading gold to the upside in the short term as well. Now, keep in mind, we had a very, very similar setup for gold going back to the March meeting. Going back to the March meeting on March the 16th, we had markets already expecting a close to 7 hikes this year. The market was already hearing quite a lot of hawkishness. It was a very similar setup where gold initially pushed lower, as we saw an initial spike to the upside in the dollar and yields. And then as the markets realized that the Fed was hawkish, but not hawkish enough, we saw yields pushing lower, the dollar pushing lower, and gold pushing to the upside. We were lucky enough, if you guys recall from our prior videos, to have literally bought in at the lows. That was a very, very lucky buy. You don't always get that lucky. But, seeing the amount of downside we've had more recently with the exact same setup, we do think some upside in gold can also be very attractive. We are also coming in on some fairly key levels of support here. 1877, that prior high going back to the 15th of November. The prior top coming in in early Jan. We're reaching some pretty key levels of support here, which we think can be interesting for gold, especially since from a medium-term perspective, we also like gold to the upside if growth slows faster than expected. Right, so having said all of that, something that does point to some, let's say that makes me a little bit uneasy going into the meeting is the fact that that makes me uncomfortable about a sell the factory action is that quite a few analysts that I highly respect seems to think the exact same way. Now, it's always nice to have other participants agree with your view, but if everyone agrees, then that's something that you should be worried about. Similarly, the retail crowd is strongly positioned for that type of outcome already. I mean, looking at some of these dollar positions, euro dollar at 77 long, Aussie dollar 75, pound at 80%. There's a lot of bullishness already priced, or let's say bearishness priced for the US dollar. It's not just the US dollar. The one that's getting me very uncomfortable, again, gold at 81%. And if you take a look at equities, retail has been buying the dip. So that makes me a bit uncomfortable. I like it when analysts, when we have a group of analysts agree, but when retail crowd is agreeing with us, that makes me a little bit uneasy because retail positioning is normally seen as a contrarian indicator, as you guys know. Now, what about the options market? If we take a look at the options market right now, let's take a look at the dollar. Let's take a look at 1 month here for a sec. Let me just get that on the screen. If we take a look at 1 month implied vols for all the dollar pairs, options market is pricing in some punchy moves based on 1 week implied volatility or 1 month implied volatility. Looking at implied volatility and then secondly looking at risk reversals. Let's just get that on the screen. If you take a look at these two in conjunction, these two are showing the opposite to what we're seeing from the retail crowd. The options market, from an implied vol and a risk reversal point of view, is edging the other way than the retail crowd. Both IVOL and RR, signaling an options market skew towards further dollar upside, not dollar downside. Just give me a second, guys. Sorry, guys. So that is the definite risk we need to keep in mind. Retail is positioned for dollar downside, but from an options market point of view, they actually skew towards the other end. So how are we planning to trade this? Well, firstly, we don't want to pre-position for any of these types of moves, right? We don't want to pre-position for bonds or the dollar or equities. We want to wait for the meeting. Also, we want to watch out for possible fake outs and then sharp reversals, like we saw with that March meeting. If I quickly go back to a lower time frame here for the dollar, what happened back in March, let me just quickly find that March meeting. Here we go. What happened back in March is at the meeting, we first saw that first initial spike to the upside. Remember, that's that same spike we saw for gold to the downside. That same spike for gold to the downside is this spike for dollar to the upside. Now, again, we got very lucky for selling the high in the dollar and buying the low in gold. But this is a very good example of we really, really want to watch out for possible fake outs. If you see that initial pop to the upside, it's very normal for the markets to have that type of knee-jerk reaction if you see something like a 50 basis point high coming out. So watching out for fake outs will be very important. Again, for gold, equities, and yields, I think it's quite simple because it's a very one-directional trade, right? For gold, it's going to be upside on a sell the fact. It's going to be upside for equities on a sell the fact. And for bond, it's going to be upside for the treasury bond on a sell the fact. For the dollar, though, it's a little bit more complicated than that because we need to think of what type of currency will we want to pair against the US dollar. Now, I initially thought that things like the euro, the pound, and the Aussie could be attractive. But again, taking a look at retail sentiment, that got me a little bit uneasy right now. The pound has been stretched lower, the euro has been stretched lower, so too the Aussie. But retail has been buying this so much. So that just made me a little bit uncomfortable with it. I think the easiest, the most simplest way to be able to express that view is just trading something like a dollar index CFD. There's many, many retail brokers that allow it. And I think that's going to be the cleanest way to potentially trade that. That means dollar index, the simplest way to trade it. Again, this isn't a trade that we're trying to take and hold for the next 4 months, right? It is a short-term trade looking for the markets to price out a little bit of that frothiness that's been priced in. And that means that if we trade this to the downside, we're going to be using some very simple markers to the downside to take profit. That means psychological lows like the 102.50, the 102, the 101.50, the 101. You can also incorporate basics like pivots, daily pivots, weekly pivots. We use all of them. I'm not going to go into all of those details right now. I think you guys know how to look for levels from a technical perspective. The baseline or the broad case right now, though, is we're looking for some potential downside. If it's a sell the fact reaction, we think it's going to be a very, very high bar for the Fed to really surprise on the hawkish side. And even if they do, based on what's already been priced in, I'm not sure how much further that can squeeze to the upside without seeing a little bit of a short-term correction.